Welcome to your Monday Futures Market Outlook for January 17th, 2011. This is Patrick Ceresna. For those of you that have not had an opportunity to try out our eMiniSource.com live trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. Plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that the market has gone through. We bullishly crossed above that at the start of 2009 and continue to remain above that 80-week moving average. At this juncture, we were anticipating there to be that correction during 2010 and subsequently a rally that lasted into the new year. That you would see levels potentially by the end of it as high as even 1350 on the upside. We're already at 1290 in a very clean rally on the upside. We at this juncture still do believe the market can achieve higher levels. The one thing that we're just skeptical about is whether or not the market can reach those higher levels in a straight line without there being some sort of a proper market correction prior to making that move. At this stage, we think that there's an increasing likelihood of a short-term profit-taking cycle, but that should amount to just a buying opportunity. When we take a closer look at that S&P 500 on the daily charts using the futures contracts, we had that November flagging formation which bullishly broke out on the upside, is now completing a move on that is headed right up into the 1290 to 13 focal points. Now there is some of the bigger picture measured moves that even potentially have this move going as high as the 1310 to 1350 area on the upside, but we do want to stress that we think that more than likely after such a rally that there first should probably be somewhere some sort of profit taking cycle on the downside before that market actually achieves those targets for let's say the end of the first quarter of the year. Now if for whatever reason, if this market was to actually proceed higher up towards 1320, 1350 in this consecutive rally without there being a market correction, it would only actually create a profit-taking cycle that will be far deeper and much stronger than it would be if it started off these levels. And so as much as some people would find it very positive if the market was actually to make it to those upside targets, but I would actually argue that the farther this market goes on the upside, the harder it's going to fall when during the profit-taking cycle that's going to subsequently follow. So the best case scenario here, in my opinion, is that we get a nice, good, healthy profit-taking cycle, good basing and a roll-up that will create a nice, clean buying opportunity. Just to review our key points, we have an intermediate bullish bias on this market. We do believe that we're still in a bigger picture bearish secular market, but at least on the short term, over even the next few months, if not even 6 months in duration, we could have still continued bullishness. So at this stage, that is certainly the bias that everyone should maintain. There continues to be momentum loss and a lack of market breadth in general, but and we continue to see this rally going purely on the back of a few large caps, but nonetheless there have been periods in the past that have we've seen this prolong for an extended period of time, so we can't use it as alone as a market reversal tool, but usually you have to think that once those large caps finish losing the momentum on the upside, that's when that profit-taking cycle will really begin. So we do have that profit-taking cycle concern. We did start off the earnings season, and the market never really got into any selling so far, but there's still several weeks in coming up ahead. We also do have option expiration coming up on Friday, so there's a number of different things that could drive a cycle. But beyond there being some sort of profit taking, we still actually think that this market will again rally, and that will simply be a buying opportunity when it does sell off. Next year, when we take a look at that NASDAQ 100, the NASDAQ really was a laggard almost until it just broke out the other week. and really got a little bit of momentum behind it. Those measured moves that we were targeting on the upside of the Nasdaq actually were in this 2300 to 2350 area on the upside. There are some obviously higher targets that we can have in a bigger picture, but more or less we think that this move itself is getting pretty mature, and just like the S&P, we are concerned at some juncture for some profit taking to get underway. Next year, I want to take a look at that U.S. dollar index futures, and when we look at that U.S. dollar, we continue to see it channeling back and forth in a very range-bound market, basically contained between the 81.50 down to the 79 level, and we've seen numerous tests back and forth in this very flat back and forth pattern. Now we did have a pretty significant short squeeze on the euro, and I'll be very curious whether or not that's it for where the euro is going to head. If we start seeing those reversals in that euro back to the downside, then again we could see the US dollar move right back to the top end of those ranges. Now there is a support line and down and around the 78.50 area, where if we did have just even a temporary break below, there's a chance that it could bounce right back into the trade range. But more or less, if any consolidation below 79 that does not immediately rally back off that 78, 78.50 area and get back above 79, then that would actually start to open the window for another US dollar decline, maybe down even as low as the 75 or 74 area on the downside, and that would certainly be something that could fuel one more leg in anything from commodities to even the broader markets. So it'll be very important to see whether that US dollar index finds support levels in here. Next year, I want to take a look at gold futures, and we more or less had this little a rally attempt back, and that little flag that I drew on there, and a reversal back down. We really have seen gold stocks take the major blunt of the damage more than even gold bullion itself. We're right now at a critical level around this 1360 area, give or take. If we see any selling that has any proper follow through below there, it will open the window for a significant leg downwards to test at minimum the 1320 area. The triple tops that we saw right here immediately was concerning, because it's an indication that the bulls simply do not have the follow through to take gold to another higher level every time they try to rally it. And so if we do have any technical breakdown here, then we should see what would be a proper flagging retracement that could even theoretically go as low as the 1250 area on the downside, but I don't think I want to target that level just yet. When we get this break, I think is a reasonable target to just go to the bottom end of those support lines at that 1320, 1330, and then if it doesn't have any ability to rally from there, we can look for a deeper sell-off afterwards. Next year, I want to take a look at the E-mini crude oil futures contract. More or less, we spent in those last few weeks of December this little period of consolidation into that first week of January, and subsequently now they've reversed oil back up into that what is now the 91.50 and 92.50 support resistance line. And really at this stage, that focal point is going to be a key pivot. We have some bigger picture measured moves that actually finish crude off in the 94 to 96 area. If crude was able to actually break above these highs, it would certainly drive more money into some of those massive energy companies that have been really carrying the indices higher, like the Exxons of the world. If we had crude oil break above that, particularly if it's accompanied by weakness in the US dollar, that would certainly drive more money into those big oil companies, and certainly could take the broader markets to one more step higher. So really a lot of this will be important to see how this reacts. Crude oil here creates a double top and doesn't actually break above this 92.50 area on the upside. Any break below 87 really would indicate that some sort of short-term top is in place, and that would be looking for deeper, fuller pullbacks. What would eventually be probably about a $10 to $14 profit-taking cycle in crude oil. Finally, I want to take a look at the 10-year Treasury notes, and more or less we had an important support line come in around the 118.5 to 119 area on the downside, and more or less we've now seen some retracing in this upwards flagging motion. We even had a test towards the 121.5 area where we have that overhead resistance on that focal point. Now this is a key moment because at this stage, if we reverse down off that reversal candle that came in on Friday, if we in any way start breaking below 120, it would certainly start a process that could have this flag break down for another full leg lower down towards the 115 level on the downside. In the same regard, if we don't have any follow through on Friday's sell cycle, and we reverse back up towards the 121.5 area, there's still the potential that that flagging wedge could actually even make its way up towards 123 before that this next leg lower actually occurs. In the big picture, we are still and continue to remain relatively bearish on Treasury notes, but during these retracing and kind of correcting patterns, we have to let them finish playing out before we actually come in again and look at playing the Treasury notes again. So let's watch whether or not that reverses off this point, or whether there's one more leg higher before that reversal back down. That was your Monday Futures Market Outlook. Thank you for joining me.